Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management.
Morning, everyone. Happy Halloween and go Jays go. Quick update from Grata, Q3 25 numbers, and then we'll get into charts of the week. So Grata is our smart living home operating system, secured over 8.6 million in new contracted revenues. That brings the 25 total cumulatively to just under 29 million bucks. Grata moves pretty fast, so that could be 30 million right now for all we know, but officially 28.8. And the contract base, which is essentially the unit count, expanded to 24,225 units. And again, we're hoping they can get that to 50,000 as fast as possible. It's a good breakdown between new developments and retrofitting. A lot of other apartments and student housing campuses and that sort of thing. So the annual recurring revenue, probably the more important number from a loan or that sort of perspective, 3,390,000 CAD. And that's just again, more landlords are basically adopting their product, and they're getting discussions that are transitioning from an app on your phone, that's cool, to no, we actually are gonna get your technicians to come in and drill stuff into the wall. The company services student housing and market rate rentals in the built to rent communities. So that's sort of their signature dish. And the hardware agnostic technology. So they have to drill a little module into, the storage room of your apartment or student dorm or whatever. It's a good sign when that happens. It does help kind of increase the performance of your building. So if you have a kind of a sleepier apartment that doesn't have much going for it, give them a call. They're in 140 buildings at this point, 54 clients, and I think things are pretty good. We're going to have Troy, the CEO, doing a podcast for us in about 1 month's time, so stay tuned. These are just some of the groups they do business with and some of the actual properties that they're in. So these are definitely towards the newer end of the vintage spectrum. I think the Parks is not even ready yet, so they're on it. Financially, really good results here. Profitable, cash flow positive, 4 million bucks in the bank account. If absolutely nothing happened from this moment forward, they could still operate for a year under their current growth assumptions. So yeah, really happy about that. And then this is just sort of from the income statement. So growth in pretty much all areas. And hey, that's what we want. Growth is growth. And then this is just a summary. So this is the cumulative total contracted revenue, which is a big number. But again, it's that annual recurring number that you kind of want to focus on, as well as the number of units actually sold. So that's great. So let's get into charts of the week real quick. I think the meat of the action here is in the slides themselves. So a good, bounce off that. It is the upper first standard deviation above the 50-day, but nonetheless, pretty definitive move off that level. The risk on, risk off indicator is way back up at the top of the strong market range. So Andrew's liking that. I mean, stocks looking really good here. Gold, it was interesting about gold. I was talking to a friend of mine at the Royal Canadian Mint. When gold sort of rolled over here, as you can see in the slide there, I'll just make it a little bit bigger. Everybody that was a gold bear was like, I told you so. It's just a yellow metal. It doesn't, mean anything. It doesn't pay a dividend, doesn't pay rent. So this is, this is a bit of a correction here. But again, like, gold's been going higher for like a couple of years now. So just kind of shows you how short-term oriented some people can be. Internals look pretty good. I think I would use the word great if that NYSE percentage above their 50-day moving average line was even higher. But you know what? I'll take it. So stocks looking pretty good here. And then this is just the standard S&P 500 slide. This panel shows the various resistance lines. So to summarize, there's several of them. In addition to the fact that the 50-day moving average, looks like a pretty good, like there's a few times it didn't even have to touch the 50-day moving average and it sort of bounced from just above that. So that looks to be pretty good. We definitely are out of that sort of funky period that we were at sort of at the beginning of Q2. So that's great. And what is he saying here? It's now going to require the largest pullback since April just to, even think about this 65.50 level, which for a couple of weeks now, he's kind of said that that's his line in the sand. If we stay above it, smiles and high fives. If we go below it, then maybe we think about where we stand. So there's that. Nasdaq is looking good too, and I mean, it has broken out of this narrowing set of panel or lines rather. So that's positive for some of the growth here and some of the more tech oriented names. Gold and silver, like I said, have pulled back, but again, they've made tremendous runs over the past few years. Maybe that's sort of lost on people that just started following gold and silver 3 or 4 weeks ago. He got to the point where he was using terms like uncharted territory, and so some of these additional setups for entry points were riskier. But he's definitely feeling good about this sort of sell off, and I think he says he'd feel even better if we got kind of into that 37, $3,800 per ounce range. Very, very good performance in gold. And, I know we've been all over it as well. With silver, he kind of would rather wait to see if it falls down a bit more. And I think the issue here is, maybe when gold kind of started to look a bit toppy, people were diving into silver. Like I remember a couple weeks back, First Majestic and some of the other players in the space, in addition to silver itself, just were literally going, every day they were going higher by several percentage points. Now you're starting to see, maybe that shifting a bit, but again, you're still well above these technical, lines and moving lines and all that kind of stuff that would indicate, that it's time to run for the hills. But again, he'd love to see a pullback. It sounds like he's kind of hoping for a pullback so he can, again, this is clearly dip buying, not selling into strength is the way he positions it. Rare earths and strategic metals. So this is interesting because, we've talked about this before. I read a report this morning that a lot of these companies, probably not surprisingly, are issuing stock like crazy. And that's, because they're able to issue stock at like $10 versus 50 cents. But in any case, he'd like to see this VanEck rare earth strat metals index cool off a bit more. I don't know how that's going to go because I didn't really follow Trump's meeting with Xi, but I think if you think the United States can solve all of its rare earth and critical minerals challenges over one weekend, I don't know what to tell you, but it's come off a bit. And, a lot of these stocks on these rare earth and critical mineral screens are still overvalued fundamentally. And so I think the magic here is if you can catch one of these at a technically opportune moment. So more of a tactical trade, I guess, is the way you could say it. Mag 7, looking like that home run last night, first pitch that Schneider hit, Davis Schneider, and then followed up by Vladdy. So these things, are sort of, again, in that uncharted territory range. And I think at this point, you probably kind of say to yourself, maybe it's time to just sort of wait for a correction, which is to say, like, if you haven't gotten into Mag 7s by this point, potentially you've missed them. Thanks, Joe. Ken.
Yeah, so just the same disclaimer at the front ends. Just contact us today if you have any questions. We'll go really quickly through these indices. Not a whole lot of changes. $3 increase for the S&P. Obviously, a pretty strong week, really led by the mega caps. Be a bit of a trend this week. Obviously, trade optimism. Got a rate cut, small one expected, and then the end of quantitative tightening yesterday, which was Powell indicated at a speech he gave, I think, in the mid-October range. Kind of expected. Obviously, all eyes are on that trade summit out in Seoul. Xi and Trump seem to be making some progress. I think he posted late last night during the Blue Jays game something about helping out the U.S. farmers. I didn't haven't been able to jump through that yet today. Overbought, oversold 92%. That's a 60% increase week over week. And that's the highest single week level since June 27th. So really seems like a bit of a return after some lower numbers in terms of demand and inflow. NASDAQ, kind of the same story. It created a buy signal, actually. That's the sixth straight. Like I said, return to risk on and growth. Support lines, you can see them labeled here a little further back. And then the overbought, oversold. Even with markets melting upward, basically since mid-April / late April, highest since June of 23. Quite the high, overbought, oversold. Dow Jones increased to new all-time high as well on this chart. That's the third. All U.S. indices reached all-time highs on their charts. It did break out of a previous range. Price objective moved up. That's the only U.S. indice that saw its price target move up. That's a technical target. Obviously a very strong week for the U.S. market overall. Overbought, oversold 66%. That's the highest since July 3rd. Obviously values lagging growth. Even with the Dow having a really strong week, you can see the spread there in terms of demand and flow from investors. Looking here, TSX 63 box increase created this nice strong support line in the short term. So really positive sign. A couple of weeks ago, I had mentioned there's no support. And then I mentioned the same thing at the end of the summer as well. So kind of created these short-term support lines, which are a real positive sign. TSX this week was really led by tech and some nuclear / uranium plays. Obviously, Cameco being a huge winner this week. Overbought, oversold 36%. That's the lowest since August 1st. So despite the turnout, we seeing some lower demand north of the border, perhaps some investors taking some profits and rotating into different markets, some emerging markets, and even perhaps just trying to catch the full blow off the top in the US and rotating away from Canada. The VIX, bit of an increase yesterday, day before, but overall a weekly decrease. You can see the sell signal here. But the one thing to note of the VIX, you can see this perfect trend line that it's bounced off about 6 times in the last, I think, 2 months or so. So we are making higher lows. And it could imply a bit of a spike coming through the end of the year for various reasons. Obviously, there's not going to be many surprises. There's not as many data dumps with the government shutdown. I think the Fed only has one more meeting, and they're kind of split on if there will be a cut. I didn't check the probabilities yesterday, but 2 days ago it was kind of split. So I'll have to see what happens there. These technical indicators, I'll just graze over them. None of them have changed in the last few weeks. Asset class rankings kind of reflecting what I've basically been saying, return to risk on. You can see the 3 bottom asset classes from a high level that Dorsey Wright tracks have lost buy signals basically over the last 2 months pretty substantially. And the top 3 up here have gained, obviously the equities the most, but the spread in between domestic and international equities is at the smallest point of this year. So very important to note, international equities really gaining some relative strength, finally turning over. Obviously, some emerging markets have performed really well. Latin American funds have really turned over in recent weeks. So I'll have to continue to see that. And this international equities asset class, we'll call it, could really start to surge on a relative basis and an absolute, especially if a trade deal gets done between China and the US, and then even an Asian developed market like South Korea, which there are rumors that South Korea and the US are pushing toward a deal. This is the S&P 500 over the equal weight, the excess return. You can see when obviously there's a negative excess return, the S&P 500 is underperforming, no surprise. Some in the early 90s, basically after the dot-com bubble burst, after the financial crisis, and then a little brief period in 22. But you can see we're closing in on the levels that we saw back in 99, right before the dot-com bubble. Just those mega caps obviously leading the charge. Overall breadth is not as strong as it once was. There's a number of larger companies at 52-week lows. I actually had a list of them open. Let me see if I can find them. And no, I don't have them right now. Nonetheless, look at crude oil here. Obviously, some Russian sanctions have popped the price of oil into the low 60s. That's the highest price in about a month and a half. The market also seems like it's tightening. I mean, probably not the best trade to be in all year in terms of owning some energy companies, but some have performed really well. We've been mentioning natural gas, some utilities providers, and even some stronger oil producers have performed on a relative basis very well compared to its peer group. We think right now, perhaps the time to be looking to broaden your exposure within the energy space, not just oil, looking at natural gas, continuing to look at nuclear energy, and then even some North American utility providers. But we'll continue to watch this chart here. As we move forward. Looking here at gold, obviously we've gotten a bit of a pullback, still hovering around $4,000. But I think if you ask someone whether it was last October or even in April or even probably in June, if gold was trading at $4,000, they wouldn't believe you. I mean, gold has outperformed numerous asset classes over a 25-year period. Yes, there are pullbacks. Yes, there's volatility, but we still continue to believe that there's going to be demands, although that demand may have slowed in the short term for some profit taking. And then just looking here, this is obviously a bullish reason for the thesis on gold and other precious metals. This is the number of global rate cuts over the past 24 months. It's a rolling average of the 2-year cumulative cuts. You can see here we've cut basically in the last 24 months as much as we did in 2010, which is obviously after the financial crisis. So you can see how rapidly these central banks need to cut in order to finance their governments, in order to decrease their cost of borrowing, obviously devaluing certain some of their currencies over that period. And then just looking here, I mentioned Latin American stocks. A couple of people have talked about it on this call in the past couple of weeks. Really some interesting value plays. Obviously, there's some risk involved with buying some of these companies, but you can see how depleted they've been over the last 15 years. Looking here at a 17-year breakout according to Crescat Capital. This is the MSCI index. So obviously there's a number of ETFs you can buy. And these stocks are trading at like 7 times earnings, 8 times earnings. Some really attractive companies. Obviously, we've gotten that that Argentinian breakout over the last few years with the Milei election win, and he just won again in a pretty astounding election. I think he added people to his Senate and whatever they call their parliament/Congress. So really seeing some tides change in the Latin American region, pushing away that classic Latin American socialism for some more pro-market politicians. And if other countries obviously continue to adopt that style, we could see some real strong returns over the next 5 to 10 years after really some lackluster returns over the last 20 years. And then I mentioned utilities as well. This is just the XLU. We don't own this, but just a good proxy for a number of the utilities that we own. It's up about, I think, 16-17% year to date, which is very good, obviously, for a utility provider. Nice yield, obviously, on a lot of these names. Obviously, the grid continues to expand. Power prices continue to move higher with these AI projects. We think that'll continue, and a number of these utility providers will be the beneficiaries of the AI trade and could be a great safe play, we'll call it, to play AI rather than buying the NVIDIAs of the world. And then this is just communication services. Really, since mid-April, since the market bottom, been one of the strongest performing sectors. But Dorsey Wright highlights how overbought this sector has been, and that it could be due for a pullback and potentially present investors with a strong opportunity to re-enter the trade. So something to watch. And then this is just a chart that I saw on X or Twitter, just tracking the market cap in US dollars of Cisco at the peak of the dot-com bubble, and then NVIDIA. You can see, obviously, it's over 4 times the size of GDP using constant prices. Back in early 2000, Cisco was only about 3.9%. So some similarities there. And I think that's it for me. So I'll pass it over to Dave.
Yeah, it's impossible to pick the top, but we got to believe that we're getting near it. And yeah, anyways, excellent. Unfortunately, the weekly or the morning coffee hasn't arrived from Canaccord, so I'll have to use yesterday's. But here we go with some things to look at. Just bear with me. Michael Coolbaugh. His weekly observations. Global equities and gold have been on an absolute tear this year. It's all part of the global easing cycle. So here's some more market peaks when it comes to this is like the one that you just I think you showed one like this. I'm not imagining, Ken, but some more of that going on. Good news, economic data collection is getting less reliable. And that's the fun of CP lie. I don't know what that means. US banks exposure to private debt surged to nearly 300 billion. While the direct credit exposure has moved off bank balance sheets, doesn't mean there's no exposure. Banks lend to private credit lends to companies, typical Wall Street regulatory workaround. Here's to my point about strained liquidity and the rumblings across private credit. We've seen increasing usage of the Fed's standing repo facility, the SRF, for firms seeking liquidity. Things don't matter until they matter. Over the last 3 days, with the market surging to new highs, we've seen a decline in participation across all timeframes. And now at the top, according to bar chart, nearly 80% of S&P 500 stocks declined yesterday. That's the worst day of market breadth ever recorded, while the S&P was making new all-time high. Wow. Here's the graphical representation from Bespoke Investment. Bad breadth is never a reason alone to bail, but to this degree, it should certainly raise your level of cautiousness. Hedge funds and institutional investors continue to be aggressive sellers of equities. Can't say that I agree with their cautiousness. However, if you want to see the ingredients for a year-end blow-off, it would be underweight active managers being forced into performance chasing. A lot of cash sitting on the sidelines. We've been saying it for months and months. 7.4 trillion the last time I looked. Oh, the morning coffee just arrived at 9:30, so I'll open that when I get to that. Argentina, Ken talked about this. It's back in play. Look at that gap upwards there as Milei scored a major and surprising victory in midterm elections this past weekend. The U.S. has pledged to do whatever it takes. I don't know why he says surprising. He had this full support of Trump if he got elected. I think 40 billion would be put into first financial support, and his opponent, supposedly, from what I read, didn't stand for any policies. He just went in as an alternative option. The U.S. has pledged to do whatever it takes to support Argentina. If you look back at when Milei first won the presidential election, the initial surge was followed by a brief pause at recent highs before finally taking off again. So we own the emerging markets, and so it would be part of that. Soybean futures. China is said to be back to buying soybeans after falling to virtually zero. And this comes with a healthy breakout following a 15-month consolidation. Earlier this year, I said to watch soybeans as that is a major lever during Trump's first trade war with China. So breaking out. And that's it for him. And I will go and find the morning coffee. Okay, we've heard about Google, Microsoft. Yeah, actually, that was covered by that Dorsey Wright analyst. The market's been quite a bit stronger. And, the dailies are red, so maybe in the short run, people would be saying that something's turning, but it looks like that everything's still going in the upward direction. Yeah, interesting there. So the year to dates is what I like to keep an eye on, just to see who's the leader right now. And Canada's doing very well, especially in the venture exchange. Crude oil still looks terrible. Nat gas going nowhere. Gold adding to it again. As silver is all green, as is copper. I'll show the Canadian US dollar on spot price. And Sean, I hope I don't preempt yours, but I'm going to do a little quick thing on the US dollar spot index and just show if that's ready to break out or break down. So we'll see what Point and Figure has to say. And then finally, I'll finish up with interest rates on Point and Figure. Okay, so with the playbook, once again, the Canada-US dollar still in the same very tight, narrow range, and with an upside of 80 cents and a downside of 62 for the long term. And I think we err towards that with all of the mishaps going on from a political standpoint, and we don't like to talk politics here because there's always half the population that is supportive to this is not being run very well, in my opinion. I'll just leave it at that. The US dollar spot index, just so you know, the US dollar spot index is made up, at least back in 2019, I don't think it's changed very much. Mostly it's made up of the euro, Japanese yen, pound sterling, Canadian dollar almost 10%, Swedish krona, and the Swiss franc. So it's a basket of those. So if, and this is what it's looking like right here, you can see for 2025, it's been straight down. With Trump in power, he did the same thing in 2017 after he got in for his first time. So at 110, all the way down to a bottom here of 96, been going sideways for some time. You've got 4 sell signals and does not look like it's reversing up, even though it's in a column of X's there. That A is October 1st, and there's September 1st and August 1st. So the trend is sideways since the summer, and we're at 99.22 right now. So it looks like really no action. This decline in the US dollar spot index has been very helpful for gold. It's one of the main levers, at least. It's not the only one, but if it was to improve, and you would think with all the rhetoric around the tariffs and the supposed success with those, that you would see it starting to break on the upside, but the market is not believing. It's actually just neutral on the whole thing. So that is my 2 cents on the US dollar spot index. So now let's move on. We've talked about oil and gas. Gas has quite a bit of upside here, according to the vertical price objective. So do the producers. So that's changed week over week. Copper looks to have some upside. Uranium down. Lots of things going on in the uranium space right now with Brookfield and Cameco running Westinghouse now, and yeah, it's a really incredible story. So uranium and nuclear power is really having a complete resurgence, and we're well prepared for that with our portfolios. Gold's taking a bit of a pause here, as are the Gold Buck Index and the VanEck majors, and are the juniors as well. They don't go up forever, so we'll just sit and wait. For our clients who are listening later, we don't really like to trade these because they're really hard to find your way back in. Yeah, so we're just going to hold our nose. We'll probably clean up some positions, and also we've got some terrific gains too, so we don't really want to be triggering those for the taxable accounts unless we have to. Finishing up silver's downside, as well as the juniors. Platinum looks to have some support, so many of our clients have platinum as well as gold and silver commodities. Bitcoin looks to be strong, Ethereum down, and Solana down, and the crypto space actually looks to be up. Lots of things going on in the regional bank space, but overall it looks like, it's flat year to date, but as a sector, they look to have some negative, which I don't know if I buy that, but we'll see. These charts are an amalgamation of everybody's thoughts, not just my thoughts. And finally, interest rates. Really no change. The 2-year looks like it's going to come off a bit with the Fed lowering rates. The 5-year measures down, the 10-year measures flat, basically, and the 30-year measures down. An ever steepening yield curve, which is good for the banks, but yeah, we shall see. Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks, and visit mcnichollasset.com to learn more.